Hello again. Welcome to week 3. You have now successfully got a good understanding of revenue recognition and matching principle, also known as expense recognition. Again, I've said many times that's 95% of what accountants do, and you as a business leader must understand what goes on in the financial statement processing in your company. Today, we're going to look at a couple of more principles. One of them, I guess you might say, is constraint, and the other one is a principle. It's materiality, which is a constraint, and disclosure principle, which is not one of the 5 key ones that I talk about throughout this course, but nonetheless, it is one of those 12 assumptions, guidelines, constraints, and principles that you need to be aware of, because disclosure comes up a lot. The case we're looking at today it's called Auto Parts Incorporated. And it says, considering materiality when evaluating accounting policies and footnote disclosure. Now, I often say that if you really want to understand what is going on in a corporation, look at the footnotes, look at the disclosures. It tells you a lot about the accounting principles that are being used, or accounting methods that are being used. Today, we're looking at capitalization of inventory. And let me go ahead and share this screen for this particular case. But before I get into this case, let me just give you one real world example there that I was involved in a few years ago at ACCT. You know, we had what was called a spare parts inventory, and that's really what Auto Parts here has as well. And we were a $2.3 billion corporation, but 10% of global revenue occurred in Bristol. We had a spare parts inventory that was probably somewhere over $1 million as far as value. And when you look at that type of value, you think, well, that had to be an inventory. In fact, everybody in the facility called it inventory. But in reality, it was expensed when it was purchased. It was considered immaterial to ACCT as far as something that should be put on your books as an asset and then expensed as it was used. You know, that's typically how you would think it would be. It's an asset on your balance sheet. It's got a useful life of more than a year. Some of the items were consumable. Most of them were things like pumps and gaskets, and it's all kinds of things that you have to have in a manufacturing facility. It was called the parts crib. It was a fenced-in area that we controlled because we didn't want people stealing things out of there. We wanted to control it so they didn't waste. We kept inventory of all that through a little standalone PC system, but everything in that crib was expensed when it was purchased. If it was used out on a capital project, it's just considered immaterial that you wouldn't put it into an asset and then depreciate it. The same token, it wasn't something that when we bought it, we put it in inventory on the balance sheet and then expense it as it was used. So that's what we did at ACCT, and never once considered making that a capital asset. Our external auditors were always concerned with Sarbanes-Oxley, SOX 404, especially after 2002. They were always concerned that we were controlling that inventory, even though it wasn't inventory. They wanted us to make sure we controlled it with doing counts and so forth, just to make sure that we were controlling our operation. But it had nothing to do with it being on the books as an asset, because it wasn't. And they knew that. They just wanted to see if we had control. We had good internal controls, which is what SOX 404 is all about. So let me go back and share this case here, because I just wanted to point that out to you. It just really hits home with me as something that I'm sure a lot of companies consider. But what's going on here with Auto Parts Incorporated, if you can read through this, very short case, right? We all like short cases. Of course, I've got a lot of other material you can read and listen to. And of course, me giving you a little 15-minute discussion of this case should help you in formulating your response to these questions that are on the last page. But Auto Parts, or the company, they manufacture automobile subassemblies. But look what's going on here. They give you some financial information, which is important here as we get into looking at what is material, right? What's significant? Materiality is another word for significant. What is significant? What is insignificant? It says during 2005, the company significantly expanded its planned and fixed asset spending, meaning they've got a lot more capital expenditures going in. So when you've got assets going on your books like that, you automatically going to have more maintenance and repair expense, which means you're going to have to buy more tooling, more, not necessarily tooling per se that goes on the assembly line, but tooling to repair things on the assembly line. So all of these machine parts and so forth that support your production lines, if you got more capital spending, you've got to have more expense spending. I know you think, well, it's under warranty, but it's not really as relevant as you might think, especially in a manufacturing environment. So they obviously are going to have to significantly increase their tooling inventory. Spare parts is another word for tooling inventory. Drill bits, machine parts, utilize the manufacturing process. In prior years, the company expensed tooling supplies they were purchased, just like we did at Exide. Beginning of fiscal 2005, controller and CFO decided they want to capitalize tooling inventory. Meaning instead of expensing, instead of debiting expense when purchased, they're going to debit an asset called inventory. Not inventory in the sense like we were making batteries, because two different kinds of inventory. Inventory, your raw materials, making your product is one inventory. That has to be capitalized. And then it goes to cost of goods sold when it's sold, right? Comes off the books as an asset, it goes to cost of goods sold, expense on the income statement. Here they're talking about the other kind of inventory, which is these spare parts. Has nothing to do with what you're going to sell. These are spare parts used to repair your equipment. And so they're kicking around the idea that, well, we're going to go back and change to, which is a change in principle. Change in the principle here that they're going to capitalize these purchases. Of course, everything they've got out there in their crib at the time, this tooling inventory, they're going to have to reclassify that as a credit to expense and a debit to asset, right? Very straightforward. It's not complicated. So it says here that it gives you some information here. It says during the prior year, 2004, the company incurred roughly $650,000 of tooling expense, held approximately $175,000 inventory on hand at the end of the year, meaning that's their physical count. We used to do physical counts as well at Exide. Even though it's expense, we did physical counts. And that physical count would be compared to what we kept on that little PC system that wasn't inventory, but it was inventory per se, in the sense that we want to make sure we had good counts, because you didn't want to run out, you didn't want to stock out on parts to be used, whether it's expense when you purchased or capitalized, right? You want to manage your business. And so they're counting this inventory on hand. In fact, all of this, these numbers in here, I've actually put together a little spreadsheet for you, because obviously most of the people in this MBA accounting class aren't accountants. Those of you who are accountants, you should be able to do this just like I did. I know there's some of you out there. There always are. But if we continue on, it says your accounting firm serves, because your accounting firm serves as external audit for auto parts. I mean, but don't think of yourselves necessarily as an external auditing firm, because this is an auditing case. But think of it in terms of trying to, as a, in the corporation here of this company, you as a business leader, how would you handle this particular case of what the CFO and the controller are telling you? And maybe it's the CEO who's one driving this to maybe, if you're putting stuff on the books, right, on the balance sheet from the income statement, obviously your income is going to be higher. Are you doing it just because you want to pay bonuses, make yourself look better? If that's the case, you shouldn't be doing it. You only change principle when it more accurately reflects the financial position of your corporation. Never for bonuses, never just to make things look better than they are. You want to more accurately reflect your company's business by changing principle. It's the only reason. All right, so going down here to this sheet that I put together for you here, old-fashioned legal pad. What we have here is 2004 and 2005. Those are the period of time, right? That's what an income statement is, a period of time. Income statement, balance sheet, the two main statements, and worry about cash flow here. So we got tooling expense, right? It's expense when incurred. And it's $650,000 in 2004, and in 2005 it's $1 million. Now 175,000, that 650 is what they've counted. 175 is a part of that. right? We've expensed $650,000, expense when purchased. The $175,000 was the actual manual physical count, which just says that's what they want to what? As I've got in red here, they want to put that on the books, right? As an asset, inventory. So you're taking it out of expense and putting it onto the books as an asset. All right, total revenue, pre-tax income, I put all that on there based on what's in the case. And in 2005, so they had total expense of $1 million. And again, total revenue, you can see it's gone up a lot, hasn't it? From 60 to 73 million. Pre-tax income's gone up 20%. And then the 300,000, that's what's coming out of the 1 million. That's what is going to be put on the books as an asset, right? Or maybe that 300,000 comes out of the 1 million. I don't remember. But regardless, they're wanting to put 300,000 on the books there, right? So if they change the principle from expensing when incurred, this tooling in this manufacturing setting, then they're going to have 175,000 on the books there, and you'll have 300,000 there. The question is this material? Is it material? Is it significant? And I've given you several examples that you can click on, materiality threshold, that you can click on and read. There's SFAS 154, there's ASC 250-10. These are SFAS was issued by FASB. ASC 250-10, all of these talk about what do you do if it's material. And I pretty much tell you what you should do there in one of the other links and the description there, that if it's material, then you need to disclose that you've got a change in principle and disclose in your notes. You don't just make the change and not tell any of your readers of these financial statements what you've done, right? You need to disclose that. You don't just change it and not tell anybody. You need to disclose what you've done and why you did it and whether it's material. And of course, if it's material, you need to restate prior years. You need to show that 175 here is an asset, right? And show that less expense. You got a new income statement and new balance sheet for that year. And of course, 2005, I think, is the year they're in. Obviously, there's no restatement for 2005, but you need to answer questions 1, 3, and 4. So let me go back there to those 3 questions. Describe whether you agree that capitalization of the tooling inventory is the preferable method of accounting for auto parts. This is up to you. You can tell me, yes, it's a good idea, no, it's a bad idea. And you need to explain why, right? I mean, this is judgment. Materiality is all about judgment. Of course, you want to be consistent, right? In what you've done, you want comparability from period to period, and you don't want to just change the principle because, well, we're going to have bigger bonuses because we've got more income, or we're going to make our earnings per share higher in a time when maybe it would have been flat, right? So that's important. But the question is it material or not? And if it is material, you need to disclose that. All right. Question 3, I blanked out question 2 because it was more of an auditing question. But question 3, in general, how do auditors develop an estimate of planning materiality? Now, these auditors are external auditors who are reviewing the statements. So what do they consider material? What do they consider material? For auto parts, what is your preliminary estimate of financial statement materiality? Are there qualitative factors which might impact your decision about materiality of the accounting treatment? Qualitative, not just numbers. What's some of the quality issues, qualitative factors related to disclosure? You can do Google searches on this as well. You don't have to just rely on the links and stuff I've given you. In fact, the more you do external searches for yourself, the better off you're going to be grade-wise. And then number 4, do you concur with management's assessment that the accounting change is immaterial and therefore requires no disclosure? Why or why not? Again, this is going to be an area that you're going to find is sort of in between, right? Let me go here and click another link, which I've already been talking 15 minutes, haven't I? That's all right. Let's see here. Going back to week 3. Let me stop share here and then share again. This thing, there we go. Doesn't always do what you think it's going to do when sharing in Zoom. But here in module 3 or week 3, a lot of good information there about materiality, what that is. Materiality constraint. It's really a constraint more so than it's not a principle per se. It's more of a constraint. Good example there, what a constraint is. I haven't completed the link here yet. That's what we're working on. The full disclosure concept is kind of principle requires management to report all relevant information about the company's operations to creditors and investors in financial statements and footnotes. In other words, GAAP requires management to tell external users material information about the company that they can use to base their decisions on, right? All right, and then FASB issues SFAS 154. There's also a materiality threshold link there, and that's what I was going to click on, which you can read. It says it's not a secure website, but anyway, it was a good link here that talks about what is a typical financial threshold, 5 to 10% of earnings, right? So if you're looking at that 175,000, if you divide that into earnings for that year, I'm going to tell you the calculation, although I just did. You got 300,000 in 2005. You divide that into earnings, right? It says that the typical financial threshold is 5 to 10% of earnings. There's other calculations as well that you can use based on a percent of assets. A lot of different ways to calculate this. This is just one way. And so that can give you an idea whether or not you think this is material or not. But you can say, no, you should keep the principle the way it is. You shouldn't change. Meaning you keep expensing this as it's incurred and not capitalizing it. Again, that's what we did at ACCT. That's not to say it's the right thing to do. It just wasn't material on a $2.3 billion company. You say $1 million sitting there. Well, what's $1 million if you're driving 300 million in revenue to that facility? And it's not that much. So anyway, that's just sort of an overview of this case without going into a lot of detail and really giving you the answers, because I want you to work at it. But again, you've got this to go by, right? Without me putting that up there again. We looked at the materiality tracker. Some hints, other hints I might talk about here, looking through some notes that I've got for this particular case. You know, it's interesting. A lot of these notes talk about, well, is it violating the matching principle by expensing it when it's incurred instead of, or expensing it when you purchase it as opposed to expensing it when it's actually used. But again, that's what's unique about materiality constraint, is it allows you to violate other GAAP, right? It allows you to violate the matching principle if it's immaterial. That's what materiality, that's what's so unusual about it. I know when you look at making this change, it really is a one-time bump. Think about it. If you're going to take the inventory I have on hand and put that on my books as an asset, it's a one-time bump. It's not like every year you're going to have an increase in earnings. You're not. It's a one-time bump. Think about it when you're looking at this. It's something good to point out. I've already mentioned about consistency. That's another one of those gaps, which that's what this course is about. You understanding how important how important GAAP is in managing your business as a CEO, from the top all the way down. And people like Bernie Evers and got the guy's name of Waste Management, Boutrock or something, Ken Lay at Enron. Maybe they knew GAAP and they just didn't care. They probably didn't know GAAP and thought it's no big deal, just a bunch of bean counters, right? But I think that's all I need to say at this point for this case. Again, good luck. I'm sure you will do well. Do the research to learn about these principles. Learn about revenue recognition, materiality, matching. consistency, full disclosure. All these are so important. There's a few numbers in this one, but they're pretty simple, which at your level that you're going to be at someday as an executive, that's what you need to see, is just the big picture. But good luck on the case. And again, if you ever have any questions, feel free to email me and I will respond as soon as I can. But thank you, and you have a good day.